Hey everyone, Eric here. Thanks for tuning in. Today, I had the pleasure of speaking with Chris Palomarez, a real estate investor in the Bay Area. Tune in to learn about his investing journey from buying a rundown property in the Iron Triangle to scaling up to 8 units and collecting thousands in rent payments. Yeah, so I just figured we could start off by having you introduce yourself, and how you got invested in real estate. Like, why is that the preferred career choice for you?
So first off, yeah, my name's Chris, and real estate actually wasn't my preferred career choice. I kind of just ended
Okay.
up in it. And as I throughout my 20s, I experimented with a lot of different career paths. One of them being cooking, and ended up going back into real estate. My family has always been a part of real estate, and so naturally, growing up, I wanted to do the exact opposite.
Mm-hmm.
And then I realized that real estate is, in my opinion, the ultimate platform to kind of get the financial freedom that I wanted to live in the Bay Area. Considering how expensive it is to live here, it also provided me with the lifestyle that I really wanted, which is financial freedom. I mean, I'm not there yet, but that is my ultimate goal. And being a cook or a chef or a musician simply was not going to provide that for me. I mean, it could have, but it would have been kind of like winning the lottery. You know what I mean? Not really.
Mm-hmm.
Uh, as certain, well, there is no certainty in real estate for sure. It's still very difficult and it's not easy by no means necessary. But it definitely opened up a lot more opportunity for me to be able to navigate and get the financial goals that I wanted to achieve.
Sure. Yeah. I mean, being a cook or a musician, it feels like it's either you're barely scraping by or you're famous and you're making a ton of money. There's not a whole lot of like in between.
Well, I'll tell you that it's like what is that? You live like a king on a joker's wage, right? Like you party and you drink like you're a rock star and you work grueling hours, but you're really just broke all the time.
Fake it till you make it, I guess. Right.
I guess, except you barely ever make it. I guess. I mean that's my experience with it, but
Sure.
it is what it is.
Sure. Well, you mentioned that your family was in real estate. I would imagine that has probably played a pretty big role in why you got involved as well.
Well, so going back to how I started originally, I was about 22, 23, and my father passed away about like 20 years ago, and he left us like around $75,000, 35,000 for me, and then the rest for my brother. And I was 23, and I was really trying to figure out what to do, and I was just going to utilize it to go to culinary school and try to get into cooking and pay for my tuitions and stuff like that. And even then, it was $40,000 a year for culinary school in upstate New York. So that wouldn't even have been enough.
Wow.
And at that time, I was working with my mom, but I really just didn't care. I had a really horrible, can I swear on here?
Sure.
I had a really shitty mentality as a young 21-year-old. I really wanted to do everything myself. I really didn't want any help. I really didn't want any handouts whatsoever. And I kind of wanted to learn the hard way. And looking back at it, yeah, it's okay then, but it was kind of foolish. And my mom's like, "Hey, why don't you take you and your brother's money and put it in some real estate?" And again, I've always wanted to do the exact opposite what mom did, just being stubborn like that.
Right.
Yeah, just being like a
Parent
late
death.
teens. Right. I was like, okay, well, what should I do? And she says, well, you know what? You're gonna have to learn on your own. I'll guide you north. I'll point north, and you just keep going that way, and then you'll figure it out on your own. And I think that was the best thing she could have ever done for me. She just kind of said, "Hey, look, go that way, and figure it out, right?" And that's exactly what I did. She put me in contact with a realtor. I had 75,000. Half of it was my brother's, and half of it was mine. And we just started hunting. This is like 3 or 4 years post 2008. So
Okay. Deals are still on the market.
yeah, so we were looking at houses in the sub $80,000 mark to buy in cash. And believe it or not, there was a ton of properties on the market in Richmond and Oakland and El Cerrito and places like that in the East Bay.
Wait, you said sub 80K
Sub 80K, a
for a
lot.
down
Yeah.
for a down payment or for the
No,
property?
no, the whole property. The property
Wow.
was valued at $70,000. But we had to go, well, not me, the realtor had to go in there with a gun. I mean, I'm not going to say his name because that's illegal, but there's like squatters, there people were smoking crack. You'll find
Jesus.
like heroin needles, and it looked like a real haunted house. And they were always in very dangerous neighborhoods. So I was like 23, and we'd go in there. I was like fearless and very stupid and didn't know anything. So I thought I was like invincible. Little did I know, like I shouldn't have belonged in those areas, period. Um,
Right.
so after months and months of going to different houses from deep East Oakland to Bay Point, and I ended up in a pocket called the Iron Triangle of
Mm.
Richmond, which
Yep.
is notoriously dangerous. And yeah, I mean, just use your imagination. You probably won't be too far off of what it is. That's probably a bad idea.
Yeah.
uh, so again, there was a full economic collapse in 2008, and neighborhoods like the Iron Triangle
Mhm.
definitely take a long time to rebound. I bought this property for $65,000 in cash, and it was, I mean, the whole thing needed to be ripped apart, gutted, electrical, plumbing, painting. The foundation was cracked, landscaping, exterior, roof, everything. And I managed to get it flipped for $40,000. When you're in a Latino family, like you know, your cousin's cousin is like this person, your cousin's cousin is like a plumber. And so I kind
Mhm.
of just utilized that to the best that I could, because I literally knew nobody at the time. And I was just navigating blindly. And long story short, I would negotiate with family members and cousins that were skilled. And I'd be like, hey, look, I can't really pay you that much right now. I'll give you 40,000, like a 40%. And on the back end, when I sell this, I will give you the balance plus interest. Right. And since it was paid in cash, I didn't have to worry about the monthly mortgage. So I could
Sure.
wait. I
Yeah.
could, pause the project, continue the project as much as I could, and navigate as long as I was kind of moving forward with pooling connections that I had in order to get this deal done. Long story short, I rented it out, and then I became a line cook and did that for a handful of years. And since line cooking paid $13 an hour at the time, there was no way I was going to live off that. So I subsidized everything from the income that I had on the property, which was paying me $1,300 a month.
So
Uh,
sorry, let me interrupt there. So you were renting out the property while you were renovating it, or how
no,
did
no, no,
you?
no. I'm sorry. I finished the renovation, and then I
Okay.
rented it out for thirteen hundred
Gotcha.
dollars. Right,
Okay.
and then I told all the people that helped me work with it, hey, look, I'm going to pay you through the monthly rental, like a couple $100 here, 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 and then when we close escrow, I'll pay you out through escrow.
Okay.
And it was all done by handshake, so there was no formality behind it whatsoever. Not that I even knew how to do it at the time. That took up like 3 or 4 years of my 20s, and the only way I survived that is because I was collecting rental income from the
Sure.
property here in Richmond.
And you were living where during that time?
So I was living with my girlfriend at the time in San Francisco, and we were just splitting the rent in like a really crappy studio in San
Okay.
Francisco. Yeah. So I bought that for 60,000 and put 40 into it, sold it for 180, and then paid everybody back. And I walked away with like 35,000, $40,000 in my pocket.
Nice.
Yeah, been over 4 years, so it was good. It was good. Um, but one of the most important things that I realized during my first deal is understanding how to do your taxes. And you think that because you sell it for $180,000, there's a bunch of closing costs, especially depending on what city you're in, what
Sure.
state you're in, what actually hits your pocket at the end of the day. But going back to that first project, it was quite the adventure, because I remember when we were in escrow, I had to pay people to live inside the property and sleep with bats, because people would come in, open up the sheetrock, and then take out all the copper and all the plumbing. And it was such a nightmare that I thought it was like the end. I was like, I'm over. Like, I'm done. I'm dead. I don't know. I don't have the money to repay for this. I don't have the money to cover this. Thankfully, the realtor came in and saved the day and said, hey, look, I will pay for this up front, and then you could reimburse me through escrow. So
Mhm.
I didn't know what that meant. I just said, yeah. And then, because it was my only option, to tell you the truth. And I just went from there.
Wow. I
Yeah, it
wonder.
was
I
pretty
wonder.
crazy.
I wonder what it's like being like a real estate agent. in those areas? Like, was he focused primarily on that, or was he just a friend that was helping you out in that particular space?
No. So he is like a family friend. His name is Frank, and I really owe him a lot. He was there for me in the beginning of my investment career. That sounds weird to say, like investment career.
It is one.
But he helped me out a lot. He really, looking back in hindsight, he barely made any money off that. Or like 3%, 4% off 75,000, 65,000, whatever it was. It's like nothing for the amount of effort that went into it.
Mm-hmm.
And he's the one that kind of guided me, and him and his son invest in the same area. So he was the one kind of saying, hey, maybe you should get this, maybe you shouldn't get that. But in hindsight, like if I would have bought any of those properties and held on to them until like 3 years ago, I would have made plenty of money. And now that property that I sold back in 2014 for 180,000 is worth $400,000 now.
Wow. Yeah, it just goes to show sometimes, I mean, you still made money, you learned from that experience, but the reality is that like holding for the long term will almost inevitably yield higher returns.
Yeah, 100%. But I think it's really important. You're right. But from my perspective, I think that from doing a bunch of transactions in the beginning, and like maybe you're not making as much, like you wouldn't be netting like to $200,000, but you'd be gaining experience from networking, from dealing with escrows, from navigating taxes, CPAs, realtors, mortgage brokers, city inspectors, and so forth, and project management. That is worth more than your gains, I think.
I agree.
Especially if you're in your 20s, that knowledge that you pick up through just experience and mileage is way worth. It's worth its weight. Or I mean, I guess there's no weight on it. It's worth it. It's worth it. It's And if you didn't go to college, that's your college tuition right there. You're paying to learn as you go, and you're making money.
I completely agree with you. I feel like when I purchased my property back in February, I had the same experience there. It was something where you just really can't learn that in a 4-year degree. It's just not.
No, you can't. You absolutely cannot. And I mean, there's so many resources out there now, like YouTube being a big one.
Yep.
But there's nothing like analyzing your own deal and closing, getting paid, realizing where you made a mistake, adapting, pivoting, and then moving forward, making another mistake, and then adapting it, and then moving forward, and so on and so on. After your fourth or fifth deal, you kind of start catching your rhythm, catching your flow, your how you approach deals, your investment style. And you end up building your team. You shift the realtors if necessary, CPAs, mortgage brokers, so forth and so forth. And people, you start introducing yourself, and it's great to have your first deal. It's really important. But when you start approaching people in terms of like higher tier, I guess, realtors that work with investors, and they ask you, how many deals have you worked with? And if you say one or two, sometimes it could be really mean and say, hey, well, we only, you're too small for us. And I've been rejected by a lot of people. And now when you get past the fourth or fifth or sixth deal, they start paying a little bit more attention to you.
Sure. Yeah, that all makes sense. And it sounds to me like you started off in a pretty rough neighborhood, pretty small, like not knowing what you're doing. But what was your idea? Like, did you feel like at this point, like after this first deal, that you wanted to continue doing this moving forward?
Yes. But it was kind of a weird way to get to that point where I realized, like, hey, look, I want to do this. The reason why I really wanted to do it is I really wanted to have stability in my life and have a strong relationship with my now wife, and be able to provide and not, make 13 or 14 or $15 an hour, basically grinding myself down. So my motivation was to be able to have some sort of steady income and be able to buy a home one day. So that was my motivation and why I stopped cooking. And once I got like that first taste of like, hey, look, I made like 30 grand or 40 grand. This is pretty good. I just made what I made in like a couple months than what I've been killing myself for the past year. And it felt great, and I decided that I needed to move forward with this, and this was like the best thing I could do for my future, and I thoroughly enjoyed it.
You mentioned taxes being something that you wanted to learn more about, or that you didn't have a great understanding of during your first deal. Did you take the profits from that property, invest them in another one, or what did you do afterwards, or did you pocket the cash?
So that's funny. On my first deal, I actually entered a 1031 exchange, foolishly, not really understanding what I was doing. And only because the escrow officer and the 1031 exchange intermediary
Mhm.
was a friend, she was able to pull me out, and actually, before the actual documents were recorded, we canceled it. I just paid the 10 grand or whatever it was on capital gains, and then I sat on the cash, and then I moved forward.
I see.
This was in 2015. And then in 2015 is when I started picking up more seriously in investing. I went over to Fairfield and then basically did the same thing I did in Richmond. Uh, and I started realizing that my net gains were not where I needed them to be for the amount of work that I was putting into, and then
Mhm.
comparing to other people out there that were putting their deals on the market, or analyzing their deals, or breaking down their deals on like YouTube or whatever.
Mhm.
And I realized I was doing something wrong.
Sure.
Uh, what I was doing wrong was I really wasn't paying attention to taxes, and saying that out loud, like, yeah, that's very foolish of me and very stupid. um, so I really figured out now that it's not only about analyzing the deal and cash flows and your network, but it's also you're doing business with the IRS. The
Mhm.
IRS does take a huge amount of your gains if you let them, and therefore, after my fourth deal, I started going into the 1031 exchange. One thing is that, at a surface level, 1031 exchange does seem very, like, why wouldn't you do this? But
Mhm.
you have to understand that you're deferring your gains. You're basically going into a bar, running up a tab, and then when you die, that tab's erased, right? But you can't access that cash without it being subject to capital gains, unless if you build up your equity position and you
Sure.
refi it out. But that's a whole different conversation. So you could build up hundreds of thousands, millions of dollars in deferred capital gains, but you
Mhm.
really don't have access to it because you have to reinvest it on another property. And when you get
Yep.
into the level of investment, most banks that deal with investors, that if you want like a prime rate, you have to put like 30% down, 35% down.
Wow. Okay.
So it transfers over, right? And then you have to buy into properties that cash flow. And that's when you get your cash in your pocket.
Mhm. Right. For those listeners that don't know what a 1031 exchange is, do you mind elaborating on that?
Okay. So I will try to simplify it as best as I can. 1031 exchange means that I buy a property for $100,000, and then 2 years later I sell it for $200,000. Uh,
Mhm.
let's just say I paid for it. I put down 50%. So I put $50,000 down, and I'm selling it for 200,000, and I made $100,000. I come to a crossroads, and the IRS is like, "Hey, you made $100,000. Congratulations. Option one, you pay us between 23 to 30%, depending on what tax bracket you're on, and then you get the net proceeds, and you move on, and the cash goes in your pocket." Option B would be you don't pay any capital gains, but none of the money goes in your pocket.
Mhm.
All the money gets transferred into the next building, but the next building has to be the same price at what you sold your previous one or greater.
Mhm.
So I now need to buy a property that's worth at least $200,000, and I need to keep going. And if I decide in 10 years after I did property one, property two, property three, because it's all chained up, it's one big running tab. If I decide to pull out, the IRS is like, "Oh, well, we've been keeping tabs. Here's your bill." And that bill could be, gigantic. It could be hundreds of thousands of dollars, and it could totally ruin you if you haven't planned accordingly to pay that big tab at the end of the day. If you are in like your fifth building of your 1031 exchange chain, you're
Mhm.
gonna have to pay for all five buildings in the past.
So what happens if you die? Would that be something that would be passed on to like your kin?
So from my experience, because I'm not there yet, and I hope not to be for a long time, but it gets erased. But again, there's like death tax, and then when you transfer all that kind of stuff, I really don't know what happens at the end. But
Everyone consult your CPAs. Don't, we're
yeah,
not taking, not
100%.
giving you
Yeah,
any
yeah.
financial advice here.
Exactly, exactly. Uh, so right now I'm in my third 1031 exchange, and then through work I've dealt with several of them. So they can get kind of complicated depending on how on what you're doing and what strategy you're trying to deal with.
Mhm.
Right now, I am actually in the middle of a 1031 exchange, and I'm hoping to close this deal because I just ended up selling this property in East Oakland that went really well. And if you want to talk about it, we could talk about that as well.
Yeah, I wanted to pivot because it sounded like initially you're investing in single family residencies and then you made the switch to
Yeah,
multifamily.
yeah.
Why the switch?
Okay, so um, it was both good and bad. I think I was just so uh, the allure of having multiple units kind of got the best of me. And I was like, wow, if I own a duplex, I'll have two doors and two revenue streams and so forth, rather than having one home. And so I didn't really in the beginning know how to analyze them. And I just kind of looked at my expenses and my overhead cost and trying to calculate my NOI. And so I bought my first duplex and I ended up losing $40,000 on that property. And it was in East Oakland. The reason why is because I completely underestimated rent control in a city like Oakland. And I thought, hey, I can negotiate the tenants and get them out and pay them to leave. But if they don't want to leave, then you're pretty much screwed. And if they never leave, or if they're there for a very long time, you're pretty much stuck in the water.
Mhm.
And that's what happened to me. And to answer your question, I think that multifamily homes are the best way to scale and generate multiple cash stream revenues, like how you're doing with house hacking. But
Mhm.
in this way, the single family homes, like if you want to replace the roof, it's going to cost you like $10,000, right? And you only
Right.
have a amount of, and it covers your single family home, obviously. But if you have multiple units, and let's just say you have a fourplex or a fiveplex or six or whatever, you could also depreciate those. And if you open up an LLC, you could
Mhm.
write that off against your expenses and so forth. And I honestly think that during like when let's just say that you're not house hacking and you rent it out to a single family, you rent out your single family home to a family and they move out, right? The expenses come out of your pocket, unless if you flip it and get somebody in there really quick. With a fourplex, one person leaves, you have three other units to float you.
That all makes sense. And it's also too something where if you have multiple doors or multiple units, realistically, you're going to be making more money than if you just have a large single family property, correct? And
Exactly.
right, and it's also well, but the con to that is that there's more risk because there's more people, correct? Like, how do you like account for like the liabilities that are related to that investment?
So it's a little bit complicated because you have to understand your demographic. And like, for example, with my experience in East Oakland, you really have to be careful what you're getting yourself into. You have to understand local laws. You have to understand rent controls if they apply. For example, in California now, the whole state is rent controlled. And I just got to make sure you have really good insurance. I think that the more people, the more liability there is naturally. People
Mm-hmm.
tend to do stupid things all the time. Like I've dealt
Mm-hmm.
with people like burning their kitchens down. I've dealt with people just abusing other people's personal spaces and so forth and so
Mm-hmm.
forth. I just have to incorporate that in part of like something that I have to part of dealing with it and doing business. And it just is one of those things that is just part of the nature of getting into
Sure.
multifamily properties and scaling up. There's
Mm-hmm.
always going to be that what if variable, that
Sure.
possibility that this person's going to be doing this,
Mm-hmm.
or this person is, for example, doing drugs or smoking meth inside the apartment. Like that's kind of crazy stuff. Or this person refuses to pay the rent because A, B, and C. Right?
Sure. And
There's always
you manage these properties yourself or these people yourself, correct?
yeah, 100%. So a rule of
So
thumb
what
that
have
I've
you learned from like that? I would imagine there's a lot to learn from being in that scenario where you're managing individuals and what they're doing in your property. Like what have you learned from that experience?
I've dealt with. It's really important to understand that at the end of the day, these people are what are paying your mortgage and paying your rent or paying for your living expenses. So I think that it's as long as you're respectful and kind of understanding and have a good communication with your tenants, then people are less reluctant to be kind of aggressive. There's always like that one
Hmm.
bad apple, if you want to put it that way, that just
Sure.
doesn't want to budge. But
Hmm.
I've learned that uh, just treating them how you wanted to be treated is very important, with limitations, obviously, and that the product that someone like me provides is housing. And I always say that housing is like the most intimate product you could ever produce or manage,
Sure.
because that's where people uh, create memories in life or whatever you want to call it.
Hmm.
So as long as they feel happy there, and as long as you are present and not like a slumlord, people
Sure.
are more. From my experience, they talk to you, and if they have some financial hardship, they are not really intimidated by your presence, and they talk to you like, "Hey, like I'm gonna be falling behind because my wife's sick and it's my daughter's birthday or whatever happens in life."
Hmm.
And as long as you work together as a team, more than not, there's always a solution to it. And that has been my experience with it. Of course, there's been people that are just really difficult to deal with, or people that lie on their applications, or people that are just malicious. For example, we've had people that uh, we've gotten a lot, like 2-year legal entanglements with, because they are hoarders, squatters. I mean,
Hmm.
and they were professional squatters,
Right.
whatever that.
Yeah.
Um, so it's definitely been an experience for me.
Yeah. Well, what I don't want to do is dissuade people from making those investments because it's something that anybody can do if they are motivated to do so. So for the person that's a little bit worried or concerned about investing in multifamily for those reasons that you've shared, like what is one piece of advice you would give them?
Well, I I really don't know how to answer that, because I think that if that is a lot of where your margins come from, like if you put your money down on a property and you want to make money off of it in the future, I think that it's part of the process of doing the hard work. It's just, if you want to just buy the property and hire a management company,
Hmm.
that's fine. I've never dealt with a management company. I just simply don't trust someone to have the as good or as the best interest for my investment as myself.
Sure. Yeah.
So I am hands on everything, and I just don't never had that perspective.
Hmm.
So I don't think I could be able to provide the right advice. But the only thing I could really say is that uh, if you really want to do it, like that's where your margins are. If you manage the property yourself,
Hmm.
if you take care of the property yourself, you're gonna have to get your hands dirty, especially in the
Sure.
beginning. Maybe
Yeah.
when you scale up and you make enough on your margins, you could hire somebody that you trust. But I don't think that I would ever, even if I got to like uh, 30 units on my own portfolio, 40 units, and like 40 units in the Bay Area is a lot, right? Like you go to anywhere else, like yeah, you can scale there relatively faster than you could in the Bay Area. But
Sure.
I would always be at one point involved. Um, I've had phone calls at 2 in the morning, 3 in the morning. Hey, my pipe exploded or something like that. Or I've
Right.
even had people, hey, look, my boyfriend came in and clogged my toilet. uh, I showed up
Mhm.
really upset, and I was like, I'm not going to deal with this.
Yeah.
It's just part of the game, and I think that if I think it's absolutely necessary, and if you're not willing to do that, then I don't know what to tell you.
Sure. Yeah, well, it's definitely going to be a time investment if you're looking to have that be such a large source of income. It's different if you have a couple of units to manage versus 40 units, obviously, but it seems like you're doing this full time, correct?
So yeah, I've gotten to the point where I'm finally doing it full time, and I'm happy to be at this point right now. But
Hmm.
now it's just like a different tier where I have a lot more responsibility, and now I have employees that I need to make sure get paid on time and have consistent income.
Right.
And
Do you, do you see yourself continuing to invest in California? Because it sounds to me like the regulations in that state are off the charts. So do you mind elaborating on that?
So I'm kind of glad you asked this question because when I started, I always, and I still somewhat do, believe that if I can't manage it physically myself, or if I can't drive to it, then stay away from it, right? That's worked out for me up to this point. And at this point, I'm feeling the tremendous amount of pressure of overpaying for properties, right? Overpaying, taxes going up, the barrier to entry in different multifamily or commercial properties is constantly growing. I am now actually strongly considering going out of state, or maybe going outside of metropolitan areas in California. Do I really know exactly what I want to do with that? I do not, but I definitely want to keep and maintain that thesis that I have, where if I can't manage it myself, then I'm not going to buy it. And
Sure.
I really don't know right now, but I do know that in the next coming years, it's going to be very interesting what happens here in the state. Um, the Bay Area specifically has been extremely competitive, and I think I've had a healthy growth rate, but I don't think I'm growing as fast as I need to in order to keep up with the pace that's going on up here.
Sure. I mean, it's not just even in the Bay Area. I mean, I would imagine the Bay Area is exploding right now in terms of prices and taxes and whatnot, but it's pretty much everywhere right now across the board. And I'm sure you're well aware of how crazy the real estate market is today. So, but
So,
Vegas is wide open for you whenever you're ready.
well, yeah, I mean, it's always definitely 8 years, and it's definitely been on my radar. So we'll see how it goes. I just can't spend all my gains at the blackjack table.
Yeah,
um,
that's the trouble of being here.
yeah. So one thing that I will say is, I live in Oakland, and Oakland has been well to me in terms of investing. But on my way to work, I always stop. I have to go through some rough neighborhoods,
Mhm.
and I'm always kind of like looking around and see what's on the market. And to give you an example of how crazy it is here, there's single family homes with bars on their windows. If you look on crime maps, you'll see shootings and with armed robbery and everything, the whole 9 yards or whatever.
Sure.
And those homes are going for $650,000, $700,000.
Yeah,
That
it's insane.
that is, I don't think that's right, by no means necessary. I think that something needs to happen to change all that. What it is, I do not know, but I know that what's going on right now is just not a healthy market.
Sure. Well, given that it feels like we've been at the peak of the market for the past year now, it just
12
feels
years in the 12 years into the 10-year cycle, right?
sure. Like it just never feels like anything could stunt the growth of our stock market and of our real estate market. Given that it feels like we are approaching some form of correction, like how are you preparing yourself for that?
Yeah, great. I'm actually currently dealing with that right now. And going back to what you just said, you could have bought a shanty that was burned down in any city in the Bay Area 5 years ago and let it sit, did nothing, and you would have made like $100,000 to $200,000,
Sure.
whatever. Uh,
Mhm.
with that being said, moving forward, it's really important within the next year to make sure that you're getting yourself into a position where you're just going to sit there and ride it out. What's going to happen, I don't know, but I know that it can't continue to go on the way that it's been going on in the past 10 years. So with my next deal, typically I turn over properties in 2 years, and I move on and move on, move on, move on. This time, I think I'm not going to be doing that. I'm going to be holding on. I'm going to buy something that has stronger cash flows. It might not appreciate as fast, or it might depreciate from what I bought it at now, but I'm going to ride it out.
Okay. And are you putting anything away towards that? Are you staying liquid? Are you in the markets? Like where's
Well,
the majority of your assets?
so because of my 1031 exchange, I can't really be liquid in terms of my positions on real estate, because if I sell and not move forward, or if I move forward in a collapsed economy, not that I'm saying that's just what's going to happen,
Mhm.
I would have to pay a tremendous amount of tax. So what I'm looking for is cash flow streams and putting aside cash as best as I can.
Okay.
And my wife and me, we work as a team. I invest in the properties, and she helps me renovate them. And she has like a she works in tech, so I help build up the equity, and she helps cash streams.
You hear that, everyone? Save your money. Something's coming. We don't know when. We don't know
Yeah,
how.
no,
Something's
yeah,
coming.
yeah, no, exactly. Something is coming. Exactly. We don't know. And I'm not going to talk like I know exactly what's going to happen. And, there's a boogeyman out there with inflation and
Sure.
all these
And
looming.
The US running out of money, literally, like in the
Yeah,
next few
yeah,
weeks here.
literally. Yeah, literally. Yeah, I don't know, but I'm not gonna, pretend like nothing is like this is too good to be true, right? A real investor is the one that can adapt and pivot
Hmm.
through any cycle, right? It's easy to make money when the economy is thriving, but learn how to make money and save money during, a recession
Hmm.
or through an economic collapse. That's when you
Sure.
get in the pressure cooker, and that's when you adapt and overcome. And that, in my opinion, that's when you learn the most.
Sure. And they say that millionaires are made during those economic collapses or corrections because they're able to capitalize on everything on sale.
Yeah, exactly. For example, go back to my point of entry, right? My point of entry, buying a house for $65,000 in the Bay Area, like
Mhm.
you would have never believed that now.
Yeah, I literally thought that you were talking about the down payment.
No, 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 no. Yeah, exactly. That's not even enough for a down payment anymore.
No, it isn't.
No.
Unless you're looking at like a 5 to 10% down payment,
Yeah,
which I
exactly.
mean,
And for those of out there that are looking to buy homes right now and
mhm.
are trying to do FHA loans and have sub 10%, wait, don't buy right now. You're going to be overpaying right now. And if the
Mhm.
economy goes down 2 points or 3 points and you only put 5% down, you're going to have a 2 or 3% equity position, if that. You don't
Yeah,
want to be in that position.
doesn't make
And
sense. It's very
it doesn't,
difficult to find a good
you're,
deal right
you're,
now.
you're buying at the top of the market, and be patient. And if
Mhm.
you're young, you have times on your side.
Sure.
Keep collecting money, keep working your job, put money aside, and the opportunity will present itself. It might not be
Absolutely.
now, but it will be, 5, 7 years. If you
Hmm.
get yourself in a problem right now, learn from the people that did that in 2008.
Sure. A recurring theme that keeps coming up in this conversation is taxes. How do
Mhm.
you find a good CPA? I'm
So,
still looking for one too
yeah,
myself.
you have to, like, it's like this akin to dating, right? Like, you go on a date and you on a first date, it's really awkward. Hey, what do you like? Of course they're gonna tell you what you want to hear. The same thing applies to realtors.
Sure.
The same thing applies to mortgage brokers, and especially now the CPA. They're not going to tell you what you don't want to hear.
Hmm.
So I just think it comes with experience. There is no, like, one and done solution where, okay, like, this is it. Like, this is my CPA, until you actually work with them and
Hmm.
you do a transaction with them and you see how they work and how they hustle. If they're not returning your phone calls, or if they are, slow at returning your emails, that's an indicator to move on.
Sure. Did you find your CPA through a website or was it through a connection?
So I've dealt with actually like 4 CPAs in the past 5 years, and I think that I found the one that I'm working with, where there is some kind of communication uh, that I wish would be a little bit faster. Not everything can be perfect, but I think I found it. But now it goes to show you, when I got my first CPA, I was like, wow, this is my CPA. I did one transaction. I was like, okay, no, this guy's done. Like, I need to go find someone else. And the same thing applies to realtors. Like, how many realtors are out there now? And if I know plenty of realtors that are really great, and I respect them tremendously. And I also know more realtors that are really shitty. And I'm like, wow, how the hell did you get your realtor license? Like, you know what I mean? Like,
Yeah.
I,
Well, real
I
estate licenses, it just feels like there's not a whole lot of correlation to the real world when you're taking an online test, right?
well, 100%. Like, you could answer the questions online, but, get thrown in an escrow that, when the shit hits the fan, see how you navigate that. You know what I mean?
Yeah.
Like,
No, I agree.
because things get chaotic during escrow, and, a seller
Yeah.
or a buyer or a tenant, when there's tenants involved, things get kind of crazy.
Yeah. Right now is definitely not amateur hour. That's for sure. I mean,
No, no,
with real estate properties going for 10, 15, even $50,000 over asking price, like it's just not, you
no.
can't be a
No,
rookie in this
50,000.
space.
No, no. I mean, I was looking at a flip that went $400,000 in cash over asking price, and I was in the middle of an escrow for refinancing a multifamily deal that I had to get. So, I mean, I would love to talk about this. The fourplex that I just sold, I acquired it in 19.
Okay.
And it had no occupants whatsoever. It was a vacant fourplex, so I paid top dollar because I could reset all the revenue streams in a rent control market and create a great amount of cash flow. You know, when you buy something that's vacant, for example, like a duplex, a triplex, a fourplex, to get a prime rate, the bank wants to have a history of income on the property, a minimum of 4 to 6 months, depending on which bank you're dealing with.
Mm-hmm.
And so there was no revenue in the property. It was a vacant property.
Mm-hmm.
So my mortgage broker had to find me a non-qualifying mortgage at 6%, right? So I stabilize the property. I find my tenants. I vest them. This is pre-pandemic, and I'm like, okay, here we go. Here's my cash flow, and I'm gonna hold on, and pay 6% for 6 months, and then refinance and prove to the bank, hey, look, these tenants are solid. They're paying on the first. I've done these renovations, a new roof, plumbing, whatever. And
Yep.
and then
and to interject there, that's like double what the interest rates are right now, correct?
Yeah.
Mm-hmm.
But you have to tie that into when you analyze the deal. You have to understand that, if I paid anywhere else the same amount and I had tenants in there, dealing with getting those tenants out is a huge what if variable. What if they don't leave? What if they've been there for 20 years? What if they're problematic and they only pay $500 a month when their rent should be $2,400 a month or $2,300 a month? I went into refinance the deal to get out of the 6%, right? Because I stabilized the property. Boom, March 2020 hit. Yeah, I was clear to close, and then the bank pulled it, like walked away from the table at the last second. So I was stuck with that property through the pandemic, paying 6%. Thankfully, all the tenants, because I vested through them carefully, and I built a relationship professionally with them, and I was kind to them. So we opened up communication. If there was any turmoil, they'd communicate with me. But the rent was always paid on time, and I survived.
That's huge.
Yeah, I accrued debt, third-party debt from investors to renovate that property. So if they didn't pay, I couldn't pay the bank, I couldn't pay the property taxes, and I couldn't pay the people that I solicited their money for.
Yeah.
And that would have ruined my relationship with those investors.
Sure.
Right.
And that would have, literally, like, I want to say that the eviction moratorium just ended like a month ago. So theoretically, they could have not been paying for over a year, right?
Yeah. And while the water bill is like $600 a month or $500 a month or every 2 months, excuse me, and property taxes and so forth, all the overhead is tremendous in Oakland. So yeah, it could have been, that could have easily, taken me out of the game for a long time.
Yeah.
But it's really important that when you get in this game that you are very selective on who you let in, because you are essentially engaging in a professional relationship with these people.
Sure. And where do you find these people?
So I posted on Zillow, Realtor.com, Craigslist, so forth, and they approach me digitally, and then I vest them through a platform that I have here on my end. And then Zillow has a great tenant screening platform as well, and you talk to them, and once you get to do this multiple times, you really have to utilize your instinct on top of doing your own actual due diligence. When you meet somebody, they can be clean and clear on paper, but you feel a little bit weird when you talk to them and they're a little bit awkward, maybe find somebody else.
Sure. Yeah, that's huge. That's going to be huge. The people that are going to be in there, especially in California, where the regulations are so difficult to get people out, especially during the pandemic. Like that just feels like it would be so difficult to be able to screen accordingly and make sure that these tenants are going to be paying on time and not destroy your property in the meantime as well.
Yep, definitely. It's very important. It's very, very, very important. I mean, I think that goes without saying. It's the pandemic has definitely taught me a lot, and it's taught me how to pivot and understand people, and pretty much moving forward, be more conservative with my investments. What areas are more, I guess, if you want to call like pandemic proof, that they're less
where there'll always be demand.
Yeah, exactly. Where is there always going to be demand? I manage commercial real estate and multifamily real estate, and to give you an idea of how we navigated through it, we had a 95% collection rate on all residential units. And then for the commercial, we had like a 60% rate. So, I mean, do what you want with that information.
Yeah, seriously.
Yeah.
At one point did you decide that you wanted to have employees? When was it too much for just one person to handle?
I think after I got past like 6, 7 units, I have contractors that I work with maintenance and paying them and realizing, hey, look, I could do without them and pocket the money, but I need to build a team at one point, and or else I'm going to be spreading myself too thin.
Sure.
And when I realize that I'm spreading myself too thin and I am lacking on the service that I provide or the quality of service I provide, is when I realized it was time. Like I need to, like, hey, I can afford it. I'm not providing the best service possible, so I need to do something about this.
Sure. You don't have to answer this if you don't feel comfortable, but it's something that I was kind of interested in. So you started off with 35K.
Yeah.
In one single family property.
Yeah.
How much in assets do you have under management currently, from a real estate perspective, and how many units comprised of that or composed of that?
So right now, no, I think I will 100% answer this. I don't mind at all. I think going back to it, I think it's really important to be transparent with people about this, in my opinion, and that way you bounce off each other and maybe help each other learn more. It's very taboo in our culture to talk about money, and that's fine. But if you're with your friends or colleagues or whatever, I think if you open up the dialogue about how much you make and hey, this worked for me, this worked for you, let's help each other get to where we need to be. I think that's great. So again, I don't mind answering this.
Sure.
Right now, I am $700,000 in net equity in properties from my $75,000, and that was over the past 6 years. And right now, I am approaching 8 units. I know that doesn't sound like a lot to most people, but in California, in the Bay Area specifically,
sure,
I think it's a good amount. Yeah.
I mean, most people will only ever own one home. So especially in the Bay Area where it's so competitive and it's so expensive, like a lot of people can't even, I mean, my generation is screwed. Like right now, the rates, the price of housing is going up way faster than how much money people can actually make at one point. So
I 100% agree. And, it's a little bit of luck. It's hard work. The cliches, you want to hear them over and over and over again. But I think, again, opening up the dialogue about money and networking, like, for example, whoever's listening, feel free to contact me whenever you want. I mean, I'm not looking to charge anyone anything. I'm always glad to help and navigate the that I can. I'll analyze your deal and I'll give you what I think is my best opinion. I think Eric could put my email address on whatever the description of the episode is. Yeah. And again, I'm not looking, to make money off anybody. I just gladly, I like to help people the best that I can. And I always learn. I'm always learning. I've been wrong, and now I've been wrong more than I've been right. And now I think I'm entering the part of my life where I'm being more right than I am wrong.
Sure. No, I appreciate that. I'm sure the listeners do as well. You mentioned, though, that you were open to analyzing their deals and their properties. Yeah. I think the last thing that I wanted to ask you for you to elaborate on was what you look for when you're investing in multifamily properties. Like, what are some telltale signs that it's going to be a really good investment for you?
I don't really have like a simple question. I obviously you have to do your fundamentals and look at what your costs are going to be, what your comps are. And for example, when you're dealing with multifamily properties, you have to look at what the rent growth is. Like a perfect tool that I like to use, if not my favorite, is rentameter.com. Go on rentameter.com, set up a profile, and you can start analyzing addresses, and it'll pull you comps of rents between studios to 4 units within the zip code within the past 3 months or within the half-mile radius. You can analyze rent comps, look at your taxes. That's really important. And then look at your city transfer taxes, because that's a big one. Like if, for example, you have to look at, like if you're in Modesto or if you're in Oakland, 2 totally different closing costs or acquisition costs. in terms of what you have to incorporate when you buy and sell a deal. The most important rule of thumb that I was taught in terms of real estate was that you make your money when you purchase a property, not when you sell it. Kind of like how Alfred Hitchcock once said, "Yeah, the movie's done. I just need to film it."
So timing, it sounding like timing is everything in that sense.
Yeah, timing is everything. You have to, yeah. So with single family homes, unfortunately, I haven't done it in a while, so I'd be kind of out of tune in terms of analyzing the deal. But I do believe in sweat equity. So like the more messed up the property is, the more, if it's burnt down, half of it burnt down, and if I get a really good deal, a lot of people are going to stay away from that, and that's where I'd like to come in. Or like these houses that I dealt with when I first started out, like crack homes, squatter homes. A lot of people didn't want to deal with that. I'm young and I have the energy and the drive to deal with it. I'll gladly do it. And not only are you going to make some money, you're going to learn a lot.
Started from the bottom, now you're here.
Yeah,
love to hear it. Love the come up.
Yeah, I still feel like I after like 7 or so deals, I still feel like I'm now transitioning into intermediate.
Almost there. It sounds like though.
Almost. I
mean, that's in California. Again, that's 8 units in California. If you're anywhere else in the United States, maybe barring like New York, you probably have a lot more units.
Yeah, so I think that I was looking at a deal in Florida just to analyze, and I could have 20 units or 30 units or 40 units in Florida, but each one is collecting like 600. This fourplex that I had, and the one that I just sold, a 3-bedroom, 2-bath unit, I was renting it out for $2,900 a month. The other ones were 2 bedrooms, 1 bath. I was renting them out for $2,300 a month. Wow. That property was grossing with laundry income over $10,000 a month, and that's only 4 units in the Bay Area.
And why did you decide to sell then?
Well, I got in and I told myself that I'm going to hit this mark, and I talked to my realtor, and long story short, we agreed that right now is a good time to get out. Sure. The property is located in East Oakland, and going back to the state of the economy within the next 2 years, we don't know what's going to happen. Yeah. I don't want to get stuck in East Oakland during, an economic turn. I don't want to find out what that's like. I don't want to sit. I don't want to be in East Oakland for the next 4 years or 3 years, not knowing what's going to happen. You know what I mean?
Sounds scary.
It is kind of scary. And if I could get my ROI that I had since the beginning, then why not? I'm not going to try to get overly greedy and be like, oh, we could squeeze it for another $100,000. No, we got to stick with the game plan, be disciplined, and move on.
Yeah, you stuck to your plan all along. You didn't deviate from that, which is important in investing as well.
Yeah, I bought the property. I with experience, kind of came up with an exit plan, and I had to stick with it. And if, let's just say, I could get more than that, obviously that's great, but I'm more than happy with what I got and move on.
It takes emotion out of the equation too. If you have something written
you
down
cannot be emotional with these things. Maybe in the first 2 times, yeah. But after you get some traction and some properties under your belt, after your 3rd or 4th, you really need to take the emotions out of it, because that could be very dangerous.
I would imagine so. Same way in the stock market. You can't be emotional there.
Yeah,
money doesn't care about your feelings, right?
No, it doesn't give a shit. It doesn't.
Although the stock market is essentially like a graph of emotions. It's nothing but emotions. But
yeah, isn't it like a representation of human behavior?
Seriously,
like fear and excitement and whatever.
I don't even feel like there's any fundamental analysis anymore. It's just literally people tracking what's going on in the news and making investments based on that information.
And a lot of it is sound. And then there's always like that goofy element, like a CEO gets caught sending like a dick pic and it crashes crashes the whole stock for the day. And
there's so many crazy stories about how the market's been reacting to such stupid news that I've heard in the past 12 months.
Yeah.
It's the rise of the retail investor.
Yeah, I think that with real estate, I know myself, and if I wanted to sell, the good thing about real estate and it could also be a bad thing depending on what situation you're in, how fast the transactions can go. With stocks, I have little experience with it. I've never been successful whatsoever with it, but a lot of the times I would just, sell or buy, sell, buy, and it's just a click of a button, right?
Mm-hmm.
With real estate, like I can't just push a button and sell.
Sure.
It takes weeks, if not months, I have to find a buyer. And by the time my excitement levels and I could calm down and I could actually think about what I'm going to be doing.
I think that's why I'm naturally attracted to real estate as well, because I prefer not to have the option of having the liquidity just like that, because it feels like it's something where I would be monitoring it all the time. And it would take time away from other things that I could be making money off of, or something else that I can be learning in the meantime. I'm just the personality that I'm always looking at it. And I know that because of my fantasy football roster. I invest like $20 in that, and I'm like glued to my screen. That's why I hate playing it, because I'm like always on it.
If you have a couple drinks on you too, like, oh, I know what I'm doing. Boom.
Big mistake.
Big mistake. And going back, going back to what we talked about earlier, about where I'm at with my positions. Mm-hmm. I didn't even start growing that net positions until like my last 3 deals. My first 2 deals, or 3 or so, I didn't enter a 1031 exchange. So I kind of cashed out, put the cash in my pocket, and I was in my mid-20s, late 20s. I got married, spent money on credit cards, and I had, with 1031 exchange, I don't even touch the money. So all the profits from the first deals, since I cashed out, I ate them all up. I ate all of it up. I bought stupid shit. I went on vacations, and then so forth and so forth. So if you're the kind of person, like, I think you sound a lot more disciplined with your money than I am.
Every now and then I have my little lapses in judgment, but it's okay.
Right. With the 1031 exchange, I can't touch it. And if I want to, I have to pay 33% or 30 or 20, whatever tax bracket you're in, to get to get any money off of it.
What does that money hit your bank account ever, or is it something where it's just automatically transferred?
Never. So I sell the property, right? It goes into the escrow company sends it to a 1031 exchange intermediary. Yeah, they hold the money, and then they send it off to the buyer, and everything's done through title. So none of that money ever hits your money, ever hits your pocket.
Sure. Okay, that makes sense. It really does work like a 401k in that sense then. Okay.
Yeah. Like that money never hits my bank account or anything like that.
Yeah. Well, yeah, you've definitely given me some ideas, because obviously I'm in a single family property right now, and I'm renting out rooms individually, house hacking, if you will. But my next investment is definitely going to be multifamily after hearing all this information that we've talked about.
Don't get me wrong. I think what you're doing is great. I admire what you're doing, especially at your age and with the climate of the economy right now. What you're achieving is phenomenal. And I think that what you just said is a good sense of direction, in my opinion. I think that once you move on from this, then you go into triplex, duplex, fourplex. And in your area, you get a little bit more bang for your buck. You get 5 years for the price of a duplex out here.
Sure. Well, the conversations I had with you and Nick at Isa's party, that was something that really shifted my idea of what my next step would be, because I initially was thinking of just buying single family and just using the own money that like I earned from my position and my sales role to invest in those properties. But then after hearing about the ways that you can leverage the 1031 exchange and use that money to essentially continue compounding your growth, it just kind of changed the game for me. So I really appreciate all that information.
It definitely changes the game, I think. And also, depending on where you're at, you could run your dollar more to make more money. If you buy 2 single family homes for, I don't know what the price is, like $300,000, you're 600,000, you could buy multiple units. You could buy 4 or 5 units, depending on where you're at, for $600,000. Don't quote me here. It all depends on where market you're in.
Yeah, absolutely.
And then, once you get your depreciation in, you can write it off against your income. And on that fourplex that I just sold, I didn't pay $1 on the income because I depreciated it. There's obviously depreciation recapture, but that's way more complicated, and that's a conversation for your CPA. But with
disclaimer again.
Yeah. you make money off these fourplexes, fiveplexes, whatever, and depending on what kind of schedule you have on your depreciation, it goes against your income. So you don't really have to
Mhm.
pay anything in
Yeah.
terms of taxes.
And for again, before I let you go here, do you mind defining depreciation for people that don't know?
So depreciation, well, I'm gonna give it a shot. So you buy a house that's worth $1 million, and depending on what kind of schedule you have, you could put a depreciation schedule over like 5 years or 10 years or 15 years or whatever your
Mhm.
CPA recommends. You basically depreciate, like, let's just say, for example, $10,000 from your $100,000 home, and
Mhm.
that will go as a write-off. And in year
Mhm.
two, you write off for 10,000, and you're
Yep.
basically um, kind of like scaling down the worth of your property, I
Mhm.
guess, in terms of the IRS, but you're
Sure.
doing it against your income if you're collecting income on the property.
Sure. So in a nutshell, the amount of money that you made in that year is decreased after you're able to write off the depreciation on your property.
Yeah, it's like an expense.
Yep, exactly.
Yeah, yep.
Awesome. Well, last thing that I wanted to cover before I let you go here, I just wanted to know if there's any last piece of advice that you would give somebody that's barely starting off into real or investing into real estate today.
Um,
Any
like
closing
anything,
thoughts? Closing
like
thoughts?
any,
Anything? Yep.
like anything, it's not easy. It's not going to be easy, and you really have to work hard and get your hands dirty. And don't get disheartened by, you can't enter. The opportunity will present itself. You just need to remain disciplined and consistent, and don't be scared. I know that it's easier said than done to, hey, don't be scared, but if your numbers make sense, there's nothing for you to worry
Mhm.
about. And if there is a problem, there's always is a solution. There always is a solution.
Mhm.
And I just come up with your game plan and stick to it.
Thank you so much, Chris, for your time. Really appreciate it. I think that today was really valuable for everyone listening. So thank you again. And I'm looking forward to staying connected.
Appreciate it, man. Thank you very much for having me.